I think what we've seen, at least in the results thus far, is that credit costs are somewhat leveling off. That's obviously a positive. As we look at the bank results, I think there is this bifurcation between trading businesses, investment banking businesses, and loan-related businesses, which I think the market is really weighting the performance of those loan businesses, and really that's been the knock-on impact to bank performance. But as we look at the banks, I think the key point here is that credit still remains very, very strong, and we aren't seeing any kind of pickup in terms of potential losses there. There was some talk around the timing of potential realized losses. The expectation is that could come towards the end of 2021. But in terms of the level itself, I think that's something that looks at least good initially.
All right, and Stephen, I want to turn back to you and actually ask about what's going on with the major averages right now. Apple shares are selling off, giving back. I mean, they were up 6% yesterday. But this, what do you make of the reaction to the product event so far, its importance to the tech kind of investing world, and also whether you think it's time for investors to pivot and look for other ways to invest their money?
Sure, I appreciate the question. I mean, I always love that quote from Bill Parcells that says, "You are what your record says you are." So let's take a step back and look what our overall record is for the S&P 500. You have major indices that are almost at all-time highs. So what does that say? That says that we implicitly believe that earnings are at all-time highs, that excitement and optimism is higher than it's ever been in history. So by nature, the burden of proof from here remains on the bull's side. Now, there's this narrative that the next leg of growth in the market is likely going to be from this pivot from growth stocks to value stocks. And I'd argue that we've probably already seen that. Let's look at some big industrial conglomerates that I use as bellwethers. Number one, Caterpillar. Caterpillar stock is almost at an all-time high. Yet if you look at their earnings expectations for 2021, from the start of 2020 till today, those earnings expectations are 50% lower, yet the stock is up over 10%. Look at Union Pacific, the largest railroad in the country, and just a great sort of canary in the coal mine for economic activity. Stock is at an all-time high, yet earnings expectations for 2021 are actually lower. So I think investors need to be a little bit cautious on that move from growth to value. And at the Federated Hermes Kaufman funds, we continue to look for companies that can create their own offense, that can generate earnings growth no matter what's going on in the overall environment.
Shepard Smith here. Thanks for watching CNBC on YouTube.